In this video, we're going to get into the 6 best ETFs to combine with VOO to help you improve your portfolio and to build your wealth faster. VOO is not only one of the most popular ETFs, but it comes out on top as the largest ETF in the market with over $700 billion of assets under management. It has a simple but powerful strategy of tracking the S&P 500, which is the index that follows the performance of the 500 largest companies in the US. And it has provided some great results, providing returns of over 14% annually in the last 10 years and nearly 15% annually since it was created in 2010. VOO's strong historical performance should not be overlooked. These 500 companies from the S&P 500 that VOO holds are spread over a variety of different sectors and industries, which lowers your risk and it allows it to be a well-diversified ETF. And through the great times in the market, along with recessions and downturns, the S&P 500 has consistently managed to provide some solid returns over time. Now, while this is a great fund, even on its own, I have 6 different types of ETFs that you can pair with VOO to enhance your portfolio to have even more diversification, the potential for more growth, or to boost your income with dividends. The first ETF to add with VOO is going to be a growth ETF. Growth ETFs hold the stocks of companies that are focused on growing by reinvesting into their business, and they have the potential for above average growth, and they're quickly expanding their revenue and business operations. And the growth ETF that I decided to go with is SCHG, the Charles Schwab US Large Cap Growth ETF. The objective of SCHG is to track the performance of the Dow Jones US Large Cap Growth Total Stock Market Index, so specifically large cap companies. And this fund contains a total of 230 holdings. And if we take a look at the top holdings of SCHG, you have companies like Nvidia, Microsoft, Apple, Amazon, Meta, and more. And these top 10 holdings make up about 57% of the fund. Getting to the sectors of SCHG, at the top we have technology, making up almost half, followed by communication, and then consumer discretionary. As you see, technology makes up a big portion of SCHG, which is to be expected since the largest growth companies fall in this sector. But keep in mind, tech is also the largest sector of VOO, and combining these funds together means you're going to have much more exposure to these high growth stocks. This gives you the potential for even larger returns and growth for your portfolio, but it also adds more risk and volatility since now you have a larger percentage in these stocks and the tech sector. Just something to be aware of. Moving into the fees, SHG has an expense ratio of 0.04%, meaning you'd be paying $4 for every $10,000 invested. The dividends for growth ETFs won't be impressive, as SHG has a dividend yield of just 0.37%, which is paid out quarterly. Now, the best part of growth funds is their performance, and SHG has provided annual returns of over 17% in the last 10 years and around 16% in the past 5 years. Some amazing results for these growth funds. And to give you a better idea, take a look at this 10-year chart of SHG compared to VOO. Quite a big difference in total returns between the two. This shows the opportunity for some really great returns from having that extra exposure to growth, while VOO serves as the core to help balance out the portfolio. And whether the added risk and reward is worth it for you or not will depend on your investing goals, your risk tolerance, and time horizon. By the way, here's a list of some other growth funds that you can come back to and take a look at later on. The next ETF on the list is going to be a dividend ETF. A dividend ETF holds a variety of stocks that pay dividends, which are a portion of a company's profits that are paid out to investors. And dividend ETFs can offer you some nice, consistent income regardless of how the market is doing. The dividend ETF that I chose is VYM, the Vanguard High Dividend Yield ETF. This ETF tracks the FTSE High Dividend Yield Index, which includes companies that offer nice stability and high dividend yields. VYM contains 580 holdings in total, with top holdings in names like Broadcom, JP Morgan, ExxonMobil, Walmart, and Johnson & Johnson. Along with the sectors it's exposed to are in financials, industrials, technology, and healthcare. You can see that this fund offers a nice spread of exposure to a variety of different sectors and it's diverse in the amount of stocks that it holds as well. Getting into the cost, VYM has an expense ratio of 0.06%, costing you $6 for every $10,000 invested. As for the dividends, VYM has a dividend yield of 2.5%, which is paid out quarterly. Now, there's other ETFs with much higher yields that work a bit differently and come with more risk, but the purpose of VYM with VOO is that it offers a decent yield and it provides some nice appreciation. Which leads me to the performance for VYM, which has had annual returns of around 11.5% in the last 10 years and about 14% in the past 5 years, which is great for a balanced dividend fund like this. And if we compare this to the returns of VOO over the last 10 years, you'll see that VOO outperforms it by quite a bit. And over the last 5 years, the gap is much smaller, but don't expect VYM to outperform VOO over the long term. This is just to show that it can provide some solid growth as well. VYM offers a diversified portfolio of stable dividend-paying companies, and with VOO, it increases diversification, it lowers volatility, and it provides consistent dividend income. Here's a list of some other great dividend funds that you can come back to and take a look at later on. This third ETF on the list is going to be an international ETF. International ETFs give you exposure to companies that are located outside of the United States. Since these markets don't always match the fluctuations of US markets, international exposure can reduce the risk and volatility in your portfolio. These funds can include emerging markets like Brazil and India, or developed countries like Japan, Europe, and others. The fund I picked here is vxus, the Vanguard Total International Stock ETF. This fund gives you exposure to international companies in both developed and emerging markets. VXUS has a total of 8,615 holdings, so it's stacked with companies, and its top holdings are in Taiwan Semiconductor, Tencent Holdings, SAP, ASML, Alibaba, and others. For regions it's primarily exposed to, they include Europe, emerging markets, and the Pacific. So you can see this fund is really giving you exposure to just about every other non-US market. For the cost, VXUS has an expense ratio of 0.05%, costing you $5 for every $10,000 invested. Shifting to the dividends, VXUS has a dividend yield of 2.7%, which is a nice plus to combine with VOO's dividend. So for the performance of VXUS over the last 10 years, it's had returns of around 7.5% and about 9% in the last 5 years. Not as great as some of these other funds, but it's key to remember that you're adding international to improve your diversification and not for maximizing your potential returns. If we look at the returns for just 2025 so far, an international fund like VXUS is crushing the S&P 500. And looking back over the last 12 months, it's still very close. Along with the last 3 years, the gap isn't huge between the two. The market goes through cycles, and at times, the international funds can outperform or perform just as well as the US. By adding international exposure, you're creating a much more well-balanced, lower-risk portfolio by truly maximizing your diversification. Also, here's a list of some other solid international funds that you could come back to and check out later on. The next ETF on the list is going to be a small cap ETF. Small cap ETFs are funds that invest in small cap stocks, which are companies that have market values that range between $250 million and $2 billion. The main benefit of small cap stocks is since they're smaller companies, they have much more potential for growth, which means they could offer even larger returns than large cap stocks. But while they do have more growth potential, they also come with more volatility and they carry more downside risk when the market isn't doing well. With that being said, the small cap ETF that I chose is avuv, the Advantis US Small Cap Value ETF. Now, unlike the other funds that I picked on this list, this one is actively managed. It invests in value stocks of US small cap companies and is designed to increase expected returns by focusing on companies that are trading at what management believes to be low valuations with higher profitability ratios. avuv contains around 784 holdings in total, with its top holdings in names like Air Lease, Five Below, SkyWest, Alaska Air, and others. And the sectors that primarily make up this fund are financials, consumer discretionary, industrials, and energy. Now, the best part about adding a small cap with VOO is that you don't have any overlap of the same holdings. Since VOO holds large cap stocks, it has no exposure at all to small cap, so by pairing the two together, you improve your diversification. So the same thing as if you added an international fund. For the fees, avuv comes in with an expense ratio of 0.25%, quite a bit higher than some other funds that I mentioned so far. But remember, this is an actively managed fund, whereas the others are passive. The dividend for avuv isn't too bad. It has a dividend yield of about 1.6%, which is going to be paid quarterly. Now, for avuv's performance, since it was created in 2019, it's had annual returns of nearly 13%, and over the last 5 years, returns of over 19%, which is pretty impressive. Now, if we compare its returns to VOO, since it was created in 2019, you can see that it's had some nice overall returns. A small cap fund could complement an S&P 500 fund like VOO to help boost diversification and to increase growth potential. Here's a list of some small cap ETFs that you can come back to and take a look at later. The next two ETFs on the list are going to be a sector and industry focused ETF. These kinds of funds are going to have stocks that are focused on a specific sector or industry, and this type of exposure lets you fully capture the growth potential of that sector or industry. But keep in mind, it also increases risk much more since they lack diversification, and if the industry or sector is struggling or takes a nosedive, you're going to be taking the full impact. Now, I wanted to give you an example of both a sector and industry ETF. So for each category, I'll be talking about both. First up, for the sector fund, I chose VGT, the Vanguard Information Technology ETF. VGT invests in both growth and value stocks in the tech sector. The second fund I chose for the industry-focused ETF is SMH, the VanEck Semiconductor ETF. And this fund tracks the overall performance of companies that are involved in semiconductor production and equipment. When it comes to holdings, VGT has a total of 317 holdings, with its top holdings in familiar names like Nvidia, Microsoft, Apple, Broadcom, and others, which you can see just the top 3 holdings almost make up half of the portfolio, so they're huge drivers in the performance of this fund. On to the sector breakdown, you can see most of the industries that make up VGT are semiconductors, system software, app software, and tech hardware. Sliding over to SMH, this fund contains just 26 holdings in total, and the top holdings of the fund are Nvidia, Taiwan Semiconductors, Broadcom, AMD, and a few others. Being an industry-focused fund, it's even more concentrated, as well as the low amount of holdings, and that the top 10 make up roughly 70% of the fund, which is pretty huge. So any of these holdings can cause some decent shifts in the fund. For the fees, VGT has an expense ratio of 0.09%, costing you $9 for every $10,000 invested, while SMH's expense ratio is 0.35%, coming in much higher than VGT and the others on this list. Performance for both of these funds is nothing short of amazing. For VGT, in the last 10 years, it's had annual returns of around 22%. That's right, 22% annually, and annual returns of 17% over the last 5 years. As for SMH, in the last 10 years, it's had annual returns of over 29%, which is just insane. And it's had annual returns of around 28% over the last 5 years. It's hard to find many ETFs with returns like this. For a better view, let's take a look at VGT and SMH over the last 10 years compared to the market with VOO. VGT basically 2x the market, while SMH 4x the market, which is downright crazy to say the least. Now, while these funds have had some truly amazing results, as I mentioned before, they come with much more risk than the other funds on this list, and they're much more volatile. These funds have benefited and will possibly continue to benefit into the future from the huge demand for AI, improvements in data centers, cloud computing, electric vehicles, and more. The largest holdings that make up these funds can also be found in VOO. For example, with Nvidia being number one in all of them, which is something to consider when you pair these ETFs with VOO, you're essentially just taking a larger position in those bigger holdings. But there are other holdings that VOO may not be exposed to as well. While some investors may find these holdings very aggressive, that's totally understandable. For some, having a smaller allocation in addition to your core holdings could be an option, and for those with a stronger conviction, a higher risk tolerance, and a longer time horizon, this could possibly be a decent size holding for you. But if having just one ETF paired with VOO is too limited for you, then maybe the addition of another fund will help. And in this video here, I talk about the best 3 ETF portfolios for long-term investing. Or if you want to see the power of how $60,000 invested in VOO could change everything for you, then be sure to check out this video here. If you made it this far, thank you for watching, and don't forget to like and subscribe if you enjoyed the video. Keep on investing, and I'll be seeing you on the next one.